Well, let's start off the show then with the first corporate. We have Mr. Shah, the ED of Corporate Affairs at Symphony, who joins us to give us a sense about demand, how are things shaping up, and also how will margins pan out from here on. Hi, Mr. Shah. Thanks so much for joining in. Well, give us a sense, first of all, of demand on the ground, domestically, and also internationally. Various pockets of the world are going through a heat wave, and a rather brutal one. Are you seeing strong amount of demand? Because the flip side is that, some pockets are also seeing demand destruction. Go ahead.
So, fortunately, summer of 22 was exceptionally good, and we registered a record June quarter sales on top of unprecedented high inventory pre-season. So, actually, at a retail level, the sale was more than 3 times of the sales what company registered. And in continuation of that, we are also witnessing very robust, solid off-season collection in the months of July and August, which has to an extent surpassed pre-COVID level. So that indicates the demand and likely sentiments.
Right.
As far as the heat wave is concerned, we have decent presence in United States, Mexico, basically in North America, where there is a good heat wave, and we are really seeing a traction. In Europe, we do have a limited presence, but whatever we can do, there is a decent traction.
All right.
Coming to margin part, even in June 22 quarter, our gross profit margin percentage was in line with or slightly higher than pre-COVID June quarter, whether on a standalone basis or on a consolidated basis, despite unprecedented hike in raw material and freight costs. This was mainly on account of very smart model mix, introduction of new models, and massive value engineering, which we carried out in last 2 years.
Right. We take your point, and, I think the street also likes what you say, Mr. Shah, because as we speak, the stock is moved off the lows and, in fact, is currently at the highs of trade. The reason for that is that you're saying that off-season sales pickup has also been extremely strong. Can you then give us a sense of what are you looking to end this year with, and especially if you compare it to pre-COVID levels, because FY20 your revenues did cross that 1100 crore mark. FY22 you did come close to that, close to around 1050 odd crores. But the first quarter itself, which accounts for a fair amount of your revenue, you've crossed 300 crores. Do you think you will cross the pre-COVID levels in terms of revenues this year? And if yes, by how much, Mr. Shah?
No, certainly that's what we are aiming at, to cross over pre-COVID level by a decent amount. And we should be back to our normal growth trajectory as we used to register pre-COVID.
What would that decent be? If you could give us a sense, would it be double digit over pre-COVID, 20%, 15%? And, how would that growth be shaped up? How much of that will be India? How much of that will be all the other places? You're seeing what, 35-40% growth in Mexico, etc. So can you tell us, the size of that growth and the nature? Where does it come from?
So I would not enter into any guesswork of the percentage of the growth, but what I can say that it should be in line with the pre-COVID era, when we used to register very robust growth. And that's applicable to standalone Symphony India business as well as our overseas and console business.
Okay.
And secondly, we took some heat in EBITDA margin in 21 as well as in 22, mainly because there was lower top line. There was a degrowth, which should also be restored back to a major extent.
Okay, all right. Mr. Shah, you're evading some numbers on the revenue front, but you're saying margins will improve from year on, and you're sounding confident that revenue, will grow at the same rate that you saw pre-COVID. We get that. But in terms of margins, your domestic revenue is already above pre-COVID levels, which is heartening. But on the margin parameter, if we look at the consolidated margins, they're still a little bit lower than pre-COVID. So what is the margin band should the street work with from here on a consolidated basis?
On a consolidated basis, we should be somewhere close to what it was pre-COVID at EBITDA level.
Okay, let me help you out, sir, then with regard to that number. You were doing high teens earlier. You know, you were doing close to around, you were doing 16, 18, 17, 20%, 19% as well. That was in FY20. So are you headed towards the high teen?
Absolutely.
High teens would be 19%. That is the pre-COVID level.
Will be in the range of 16 to 19%.
Got it. We got a number.
16 to 19% is a broad range, but we will, given your optimism, assume that it would be in the higher end of that high teen, the band that you're talking about. But I'm just looking at a couple of other things as well. In the first quarter, you did increase your ad spends. I mean, it was almost 12% of sales. Going forward, what is this number likely to be? How are you looking at ad spends? And D2C as a proportion of your overall sales, how much would that be?
So normally we do have the highest ad spend in summertime, that is June quarter,
Yes.
followed by March quarter. So I would say that almost 60 to 65% of the ad spend for FY22 we have already incurred. In September quarter and December quarter, we do have negligible ad spend. So remaining 30-35% should happen in March quarter.
Okay, all right. The other aspect is the way the US markets out there you have performed, which is really, really good. I recall you were at 1 to 2%. I think that number has gone up to around 6-7% odd. If you could tell us what is the market share you're looking at, particularly for the US market, and also the revenue growth. That's grown up big time. If I'm not mistaken, I think it's up nearly around 2.5-3 times, in comparison to what you were doing a few years ago. So this year, what kind of a number you're looking at in terms of revenue from the US markets?
So as such, about 3.5-4 years before, our US sales was just about 20 crore. In FY20, at a console level, our US sales is almost 140 crore. So grew by 7 times. In current year also, we should register a decent growth. But as of now, we are keeping the finger crossed in terms of the robust growth percentage, mainly on account of the local economic situation.
Right.
Otherwise, there is a huge potential, and apart from current business channel of Home Depot, we do have the local well-established brand on account of acquisition. We do have the local established models, and we are also tapping several other channels in US.
Got it, sir. Mr. Shah, if you could tell us what should your market share go to in the United States? You've grown big time from 2% to around 6%. Where's that number headed? Very quickly.
It should be easily in the medium term in double-digit percentage.
All right,
got it.
take that point. And, on India itself, 75% of the market, you said, was unorganized. Can you give us a sense of at what pace is the organized space growing? And have you maintained your market share between 40 to 50% that you've been talking about of the organized space? Because, raw material prices are increasing, and every other people that we speak to, they are saying that the organized proportion is increasing in the industry.
Sure. So here, quantity-wise, organized should be now about something like 27-28% versus 25%. Value-wise, organized should be easily around 40% of the industry size.
Okay. All right.
Secondly,
yeah, go ahead.
there is a gradual shift from unorganized to organized due to several reasons as known to everybody. And coming to our market share, we are absolutely in the range of 40 to 50%, in fact, in the upper range.
Okay, very quickly, cash in the books, what is it? And are you looking at any inorganic growth? Because you're talking about doubling your revenues in the next 4-5 years.
So it's close to 600 crore as on 38 June. And ours is asset-light, capital-light business model, and more than 90% of the profit is free cash flow. So we want inorganic growth just to deploy their cash,
Right.
unless it is a compelling business opportunity.
Take that point. Always a pleasure speaking with you, Mr. Shah. Thank you for laying out the business prospects for us, sounding extremely confident with regards to the growth that you foresee in this year, with margins between 16 to 19% as well, maintaining market share in India at least at half of the organized market. The stock at the high point of trade.